Hello and welcome to G Fun Facts Online. Today, we're talking about a dream. The dream of higher education. For generations, a university degree was seen as a golden ticket, a guaranteed path to a better job, a better life, and upward mobility. But for millions of people around the world today, that dream has been twisted into something else entirely. It's become a ball and chain, a financial burden that can last for decades. I am talking, of course, about student debt. This isn't just a problem you hear about in one country. It's a sprawling, international crisis with a different face in every nation, but a shared sense of urgency. From the mind-boggling numbers in the United States, to the unique systems in Europe, and the growing crises in Asia, the cost of learning is shaping the future of an entire generation. So today we're going on a global tour of student debt to understand how we got here, what the consequences are, and where we might go next. Fasten your seatbelts, because the numbers are staggering and the stories are powerful. Our tour has to start in the United States, the undisputed epicenter of the global student debt crisis. The numbers are so large they almost lose their meaning. The total student loan debt in the U.S. has ballooned to roughly $1.75 trillion. Let's try to put that number in perspective. $1.75 trillion is more than the entire annual economic output of countries like Australia or Brazil. It's a colossal sum of money, and it's not held by a few billionaires. It's owed by about 42.5 million Americans. That's more than the entire population of Canada. As of early 2025, the average federal student loan balance for each of those people is a record-breaking $39,075. Imagine starting your adult life, not at zero, but nearly $40,000 in the hole. So how did it get this bad? The primary driver is the skyrocketing cost of tuition. For decades, the price tag for a university education in the U.S. has been climbing at a rate that leaves both inflation and wage growth in the dust. A college degree that your parents or grandparents might have paid for with a summer job now requires a mortgage-sized loan. The consequences of this massive debt load are not just numbers on a spreadsheet. They are a heavy drag on people's lives and the entire U.S. economy. This debt is a major reason why young people are delaying huge life milestones. Think about buying a first home. The Federal Reserve, the central bank of the United States, did a deep dive into this. They found that between 2005 and 2014, the rise in student debt was responsible for about 20% of the drop in homeownership among young adults. To put it more starkly, it stopped 400,000 people from being able to buy a home. That's a city's worth of people locked out of a key part of the American dream. And it doesn't stop there. The burden also affects decisions about getting married or starting a family. When you have a massive monthly loan payment, it's hard to feel financially secure enough to take on other responsibilities. It also stifles innovation and entrepreneurship. You might have the next great billion-dollar idea, but if you're weighed down by tens of thousands of dollars in debt, are you really going to quit your stable job to take that risk? Studies show the answer is often no. People with significant student debt are far less likely to start their own business. Beyond the big economic picture, there's the immense personal cost. The financial stress is constant, impacting mental health and forcing millions of graduates to cut back on essentials, delay saving for retirement, and live with a persistent anxiety that overshadows their daily lives. The American system, in essence, asks young people to take a huge financial gamble on their own future, and for many, that gamble is not paying off. But is this high-risk, high-debt system the only way to fund higher education? Not at all. Let's cross the Atlantic and then head down under to look at a fundamentally different approach pioneered in the UK and Australia. Both countries also have high levels of student debt. In England, for example, the average graduate leaves university with a debt of over $54,000, which is even higher than the US average. But here's the crucial difference: how they repay it. They use a system called income-contingent loans, or ICLs. The idea was first introduced in Australia way back in 1989, and it's beautifully simple in its core principle. You only make payments on your student loan when you can actually afford to. It's a loan with a built-in insurance policy against financial hardship. Here's how it works. After you graduate, you don't have to pay a single cent back until your annual income crosses a certain minimum level or threshold. Once you start earning more than that threshold, a percentage of your income is automatically deducted to go towards your loan. It's handled through the tax system, so it's seamless. You don't have to remember to make a payment. If you lose your job, or your income drops below that threshold for any reason, your repayments simply pause. They automatically stop until you're earning enough again. This one feature completely eliminates the terrifying risk of default that haunts millions of borrowers in the US system. You can't ruin your credit score or be chased by debt collectors for a student loan you simply can't afford to pay. While both the UK and Australia use this ICL model, they have some important differences. Think of it like two versions of the same software. In Australia, once you cross the income threshold, your repayment percentage is calculated based on your entire income. This, combined with generally higher graduate salaries, means Australians tend to repay their loans much faster. In England, the system is a bit more forgiving in the short term. Repayments are calculated only on the portion of your income that is above the threshold. So if the threshold is £25,000 and you earn £30,000, you only pay a percentage of that extra £5,000. The trade-off is that it takes much longer to repay. In fact, the English system has another feature. Any remaining debt is completely forgiven after 30 years. This sounds great for the individual, but it means that a huge portion of the loans given out in England will never be fully repaid. That outstanding balance is ultimately paid for by the taxpayer. Despite these details, the income-contingent model is widely seen as a more humane and economically stable way to manage student debt, ensuring that education remains an investment, not a crippling liability. So we've seen the high-risk American model and the safety net approach of the UK and Australia. But what if we took it even one step further? What if higher education didn't have to come with a massive price tag at all? What if it was free? This isn't a fantasy. Let's journey to continental Europe, where several nations have built their systems on this very idea. Germany is the poster child for this model. In 2014, it abolished tuition fees at all public universities, not just for German citizens, but for international students as well. You heard that right. You could, in theory, go to Germany and get a world-class university education without paying a single euro in tuition. Other countries like Norway, Finland, Sweden, and Slovenia also offer tuition-free higher education. They treat it as a public good, like public parks or libraries, funded primarily by taxpayers for the benefit of all of society. Now, it's important to clear up a common misconception. Tuition-free does not mean cost-free. While students don't have to pay the university for their classes, they still have to pay for everything else: rent, food, transportation, books. These living expenses can be significant, especially in expensive Scandinavian countries. Because of this, many students in these free college countries still need to take out loans. In Sweden, for example, about 70% of students still graduate with some debt to cover their cost of living. However, the average amount is around $20,000. That's a substantial amount of money, but it's about half the average debt load of an American graduate. The German system tries to minimize this by relying more on parental support, but it also has a state aid system for students from lower-income families, which often comes as a mix of non-repayable grants and zero-interest loans. The success of these tuition-free models proves that it is possible for a government to heavily subsidize higher education to make it broadly accessible without burying students in debt. But, and this is a big but, implementing such a system in a country like the United States, with its much larger population and different political culture, would be incredibly expensive and face enormous political challenges. Still, It provides a powerful counterpoint, showing that the high tuition, high debt path is a choice, not an inevitability. So far, we've focused mainly on North America and Europe, but the struggle with student debt is rapidly going global. In parts of Asia and Latin America, the problem is escalating, often driven by a big push towards private universities and the expansion of higher education. Let's take a quick look at some of these emerging crises. In South Korea, there's a huge cultural emphasis on getting a university degree to succeed. But over 80% of the country's universities are private, which means high tuition fees are the norm. As a result, student debt in South Korea has been growing faster than any other type of household debt. It's a similar story in Japan, with its landscape of mostly private universities and a heavy reliance on loans that creates a significant burden for new graduates. Some countries are already looking for solutions. Malaysia, for example, was grappling with billions of dollars in outstanding student loans from its government loan fund. Seeing the success elsewhere, it decided to introduce its own income-contingent repayment plan, modeled directly on the systems in Australia and the UK, to make repayment more manageable. But perhaps the most dramatic example comes from Latin America. In Chile, the education system was heavily privatized, leading to a debt-fueled model that locked many people out. This didn't just cause financial hardship. It became a flashpoint for massive social and political unrest. For years, Chile saw huge student-led protests that brought the country to a standstill, demanding reform. It's a powerful reminder that when student debt reaches a breaking point, it can threaten social stability. A common, heartbreaking problem in many of these nations is a mismatch. The number of university graduates is exploding, but the number of high-quality jobs isn't keeping pace. This leads to widespread unemployment and underemployment, where graduates are forced to take low-paying jobs that don't require a degree, making it nearly impossible to repay the loans they took out to get that degree in the first place. So, after our whirlwind global tour, what have we learned? It's clear that there is no single, perfect solution to the student debt crisis. How to pay for higher education is one of the most complex balancing acts of our time, a constant tug-of-war between cost, access, and responsibility. Around the world, the debate is raging, and a few key ideas keep coming to the forefront. In the US, there's a major political push for widespread debt forgiveness, a proposal that would provide immediate relief to millions and potentially stimulate the economy. But it also raises difficult questions about fairness to those who already paid off their loans and the massive cost to taxpayers. The income-contingent loan model, as we saw in the UK and Australia, is gaining a lot of international traction. It offers a market-based solution that cleverly removes the worst financial risks for students by ensuring that repayments are always tied to their ability to pay. Then there's the European model of tuition-free, state-funded education. It stands as a powerful example of treating higher education as a public good, an investment in a country's future, though it requires a deep and sustained financial commitment from the government. Experts are even exploring brand new funding models, like putting a small levy on companies that hire university graduates, spreading the cost between the student, the state, and the employers who benefit from a skilled workforce. Ultimately, the global challenge is to build a system that makes education affordable for students, while also being financially sustainable for universities and governments. As a degree becomes more and more essential for economic success in the 21st century, finding a fair and effective way to pay for it is not just an economic debate. It's one of the defining social challenges of our time. The futures of millions of young people and the long-term health of our national economies truly hang in the balance. Thanks for joining us on Fun Facts Online.